Welcome! CPA Planet lessons help you get more points on your CPA exam. These lessons provide clear explanations from the student's perspective, visual learning, and we even try to make it interesting and entertaining. Enjoy the lessons and pass the CPA exam. Okay, home sale income is excluded up to certain amounts, and there's certain rules, okay? So the exclusion amounts: single, $250K, married, $500,000, $500,000. Surviving spouse, $500,000. Rule is you must sell the house within 2 years after the death of the spouse. If sold after 2 years, then the exclusion drops down to $250,000. So that's the surviving spouse amount. The requirements, the rules are: you must be the owner, you must have resided there for 2 of the 5 preceding years before the sale. And if you're married, then both spouses have to meet the residency requirement. However, only one spouse needs to meet the ownership requirement. So, as an example, you could buy a house, you own it, you're Donald Trump, you got a new wife, she's a foreign model, you still own the house, you don't give it to her, you got a prenuptial agreement, marriage agreement. So, if you guys both live there for 2 of 5 years, then you sell the house, then you can exclude the income. If you live there for all 5 years and she just lives there for 1 year and you sell the house, you do no longer can exclude it because you're married and both spouses have to meet the residency requirement. If you both live there for 5 years but you only bought it 1 year ago because you were renting for some reason, and then you sell it, no, you do not get the exclusion. So remember those rules, practice them a little bit. You can do this multiple times. So basically every 2 years. The rule is every 2 out of the past 5 years. So you live somewhere 2 years, and then you sell it, and you meet the requirements, you get the exclusion. Live somewhere else 2 years, you get the exclusion. 2 years, you get the exclusion. You can do it every 2 years. Okay, so we got an example here. Bertie and Honoria Wooster. They meet the ownership and residency requirements. They have a $1.1 million gain on the sale of their mansion. They can exclude $500,000 because they're married. The additional $600,000 gain would be taxable even though they met the requirements. See the property lesson for even more details about this, but that's the rule. So just remember these rules for income.